Hello and a warm welcome to another edition of Econoday Unplugged. It's Monday, the 20th of May, 2024, and on today's podcast, we have Terry Sheehan on the US East Coast, Max Sartos in British Columbia, Brian Jackson's in Sydney, and I'm Jeremy Hawkins in London. I can say it in London. It's been a little while since our last global roundup, so that's what we'll be updating today. Financial markets remain volatile and, as last week's moves emphasised, seemingly still largely at the mercy of the latest inflation data. At the same time, diverging performances among the major economies continue to provide scope for a broader decoupling of central bank monetary policies. Within the G10 group, so far, it's been only the Swiss National Bank and the Swedish Riksbank that have cut key interest rates, but that could well change soon. Anyway, to Terry first then. Terry, expectations about Fed moves have been all over the place in recent months, not least due to shifting expectations on where inflation is headed. So what's your view on where we go from here?
Well, we got our CPI report for April almost a week ago now, and it was a little bit improved from what we'd seen in the first quarter. But I think markets got way ahead of themselves anticipating a Fed rate cut anytime soon. We still have a lot of hawkish talk from Fed policymakers.
What's it all about? I mean, why you say is inflation simply not coming down fast enough? And if that is the case, what part of it is keeping prices up?
Well, we're still in the problem of services inflation and what the Fed calls non-housing services inflation, which account for a substantial part of consumer prices. It's just not coming down fast enough and consistently enough in the view of Federal Reserve officials. Every time a government economic report comes out that addresses inflation, markets are reacting to very small one-month moves, and Fed officials are looking for a period of, well, Powell's been talking in terms of a quarter right now. So we need to see several months in a row of improved inflation before anyone should start thinking that the Fed is anything except on hold.
Yeah, I guess it's a real problem for the Fed and indeed other central banks at the moment, isn't it? When you have investors and financial markets in general, they're so focused on inflation that the prices become, well, asset prices become ridiculously sensitized to simply what the latest inflation is, irrespective of what it actually means anything for the trend.
Yeah.
In terms of, yeah, sorry.
I was going to say, overall, the U.S. economy is doing all right now. It's showing some signs of slowing down a bit, which is in line with Fed forecasts. So Fed policymakers actually, well, they shouldn't be satisfied with the inflation data, but they should be at least modestly optimistic that the economy is growing in a way that they have anticipated. And therefore, when they set their forecasts when they meet in June, the chances are they're going to have greater confidence in their forecasts than they did last time around.
How important do you think it might be to policy the last set of employment data? Well, April non-farm payrolls up 175,000, which certainly caught markets by surprise on the downside. Do you think, again, without putting too much emphasis on just one particular month's report, do you think this is some sign now that perhaps the labour market, which clearly is very tight your side as it is in most parts of the world at the moment, is beginning to ease a little bit?
I think so. Of course, as you said, 1 month's data, and it comes after a very strong month. So I think we have to kind of average this out a little bit. But growth on an order of 175,000 is not bad monthly growth for data. Mm-hmm. It just means that the labor market continues to normalize. We're seeing the rebalancing of labor supply and demand. Hiring is slowing. On the other hand, layoffs are not increasing. So at the moment, we still have a fairly stable labor market.
So what's the kind of calls for second quarter GDP at the moment?
Well, they're kind of all over the place, but it is looking like it's going to be something below 2% right now.
And you think the Fed will be happy with that?
I think so. I think as long as we have a positive quarter, it's going to be all right with them. And again, they've been anticipating for quite some time that the U.S. economy is going to slow. So, so far, it's been growing above expectations. And I think one quarter, even a little below expectations, is not going to change much for the policy outlook.
Okay, fair enough. So when do you think the Fed might finally cut then?
Oh, I would say not before September. I would mostly be looking more toward December at this point.
Okay, fair enough. Anything else from your side, Terry?
Well, the one thing that we're seeing very much in the data is surprisingly weak housing market data. Now, you know, this is mostly due to the fact that home prices, because of a lack of supply, are remaining relatively high and in most markets rising, while that mortgage rates continue to be around 7%. We have a whole generation of home buyers right now who haven't seen rates anywhere near that. And we have a whole group of homeowners who have rates in 3, 4, 5% range who are not going to be letting go of their mortgage anytime soon. So that continues to be one of the big factors in the inflation picture here in the US.
Okay, watch this space, as they say. Great, thanks a lot for that, Terry. Max, let's move across the border to you and Canada. Tomorrow we'll get the April inflation report. There's still certainly, well, a good deal of uncertainty, but certainly some speculation that we could see the Bank of Canada reducing rates as early as June. How important is tomorrow's number going to be?
It is very important, as you have just mentioned, but the Bank of Canada's leadership has, for the last several months, they've been saying they're not just looking at the CPI report, but they're looking at wage pressures and other indicators to see if there's any pressure in the housing market. Or so it is important, but if you just look at the CPI total or core, you can see the progress has been very gradual. So the situation here is almost the same as in the US. The central bankers are basically letting the restrictive policy rate do its work to bring the inflation back down to the respective targets.
Okay, but would it be fair to say that, I'm just looking at Econoday's expectations, the consensus data for this, I think we've got yearly rate for the headline number at 2.7 down from 2.9%. If we were to see as an upside surprise, let's say we actually saw inflation go up to 3%, do you think that would definitely mean no cut in interest rates next month?
And a good point, yes, that leaves the impression, not just the impression, but the reality that we're being sort of affected by rebound in commodities, energy prices recently, and what's really killing the average Canadian is the high rents. But it's the bank is in a kind of tight spot because, you know, if you let the inflation go a little higher, then that's going to add upward pressure to not just mortgage, but the rents. And then, but if you actually cut interest rates, you may not be able to control inflation. So it's a very delicate situation right now.
Okay, right, that's inflation. What's going on with the real economy? Because there seems to be some, say, different signs coming out at the moment. What's your feeling about that?
Compared to the US, Canada is really underperforming. Two reasons. Adults population is growing fast in Canada because of its open immigration policy, and the economy needs input, but unfortunately, the labor market is not generating enough jobs for an influx of people. So while the new residents are adding, supply of labor, they're also spending, so that's good for the economy in general. But then that means they're also adding pressure to inflation. And the other thing is, compared to the U.S., Canada's productivity hasn't really made much progress. So that's these two things are really making a huge difference between the two countries.
Okay, fair enough. Decoupling. How difficult do you think it might be for the Bank of Canada to come out and cut interest rates on the assumption that the Fed holds steady, at least over the next few months?
Yeah, I understand the governor of the Bank of Canada has been asked the same question in the past several months. His answer is always they do pay attention, but they have an independent policy framework. So in the end, they do look at what the Fed's doing and what's going to happen, but it's not the most important factor, I think.
Okay, fair enough. Right, let's go across to Japan then, where we had, I guess, some surprisingly weak first quarter GDP data. How weak was it? Was it really as weak as perhaps headline numbers suggest? Because obviously we got knock-on effects from Toyota's shutdown in there. So given that we still got all this speculation about BOJ tightening, do you think the real economy can withstand tightening, or is the first quarter GDP figures reason for being a little bit more cautious about how rapidly the BOJ is going to raise rates?
I wouldn't be too worried about the GDP's weak outcome. I mean, slightly weaker than expected. Mostly because a lot of the downturn was from Toyota Group's shutdown of the operations in January, February. Mm-hmm. So that had a very widespread impact, as you can imagine. A lot of subcontractors and related industries, not just the auto industry. So it's just depressed consumption and industrial production and capital investment. But what I'm more worried about is the weakness of private consumption. It's definitely been hit by high prices. And first, during the pandemic, a huge spike in import costs. The problem with Japan is, I think, compared to other major economies, is that companies were gradually raising prices because they didn't want to lose market share. So the suppliers, I thought that the peak of the goods prices, the markups were done, but there are more companies planning because they're really gradually raising. And then maybe last year they thought it was safe to raise because everybody else was raising prices. So it's sort of prolonged this period of reflecting high costs. And now we see energy costs are rising, international transportation costs are rising. So it's really bad news for people struggling to make ends meet. What does it mean to the Bank of Japan people? They do want to, I think, keep raising the short-term target by 25 basis points, maybe, I don't know, every 6 months. So that's gradual still, and real interest is going to be still negative because of inflation, about 2% or over. So they're not going to, the action's not going to kill the economy, but is it politically popular or not? In a normal situation, maybe ruling party executives say, well, you have to be careful about, raising rates, but Kishida's popularity is really down. Part of the reasons is that they're not really controlling the inflation. So I think business leaders, political leaders, they wouldn't mind, or they actually want the BOJ to raise rates and then hopefully bring the dollar down against the yen. But then, as you can see, you can't really control the forex market when everybody else wants to buy dollars. So maybe I'm answering your next question, but even if they raise rates, I don't know, this summer, it's not going to kill the economy, but it's not going to really hugely affect the dollar-yen rate.
Yeah, I was going to ask you about that because we had clearly, well, what appears to be sizable intervention, at the end of April and beginning of May, wasn't there, in terms of dollar yen? At one point, we did see the dollar trading above 160 yen. So it's presumably it must suggest that the authorities are actually getting somewhat concerned now about what's going on in the FX market.
Right. Yeah, I think the MOF intervention team did a great job about hitting the markets when the trading was choppy towards the end of the Golden Week, and actually no, in the middle of the Golden Week. So that was a good move, and then they were waiting until better news was coming from the U.S. In terms of the relationship between the two countries' interest rates. But again, when there's actual demand to buy dollars, and the economy is still not doing well in Japan, and the U.S. is booming, so or I would say maybe resilient, more like it. It's really hard to change the direction of the dollar yen. So at least politically, I think the Bank of Japan can say, okay, we are mindful of the yen's impact and weak yen's impact. So raising rates should help lower import costs.
So I'm presuming Japan would love to see the Fed come out and cut interest rates early.
That's correct.
I saw a quote from, I think it was a former Bank of Japan chief economist last week, forecasting a possible 3 further interest rate hikes in 2024, with June being the first. Now, I'm not sure if there's any mention of an actual magnitude of interest rate hikes, but assuming they're small, do you think something as aggressive that is possible this year?
Oh, you mean how frequent?
Yeah, we're talking the 3 interest rate hikes. I assume they're talking at least 10 basis points each time, with the first coming in, say, in June. So we're talking a minimum of 30 basis points by the end of 2024. Do you think that's plausible?
It's possible, but I don't think necessarily thinking about how often this year. It's going to be interesting to see what they're going to project for 2024, 25, 26. These are fiscal years, but we have 2 more quarterly outlook reports in July and October, but I don't think the forecast 3 years out is going to change much. I think we have to wait till next April, not just January, to see how their longer term visions or projections going to change. So if their 3-year forecast is not going to change much, that's just about 2%. So they could do anything they want, looking at other factors. And I think 25 basis points each time would more make sense, because they do have to adjust their policy to a more normal framework. And if they just raise by 10 basis points, that's going to take much longer time, and anything could change between now and 2 or 3 years.
Okay, interesting stuff. Anything else from your side, Max?
We're just looking for signs of lower house election in Japan, and as you can see, the prime minister is not popular. The ruling party is not popular because of the money scandal, and they still have now a year and a half. But I don't think the prime minister wants to leave the impression that he's being forced to wait when to see if this approval rating is going to go up. So we are looking at maybe this summer or fall, maybe after September, LDP's convention. So for that reason too, maybe in the US too, the central bank doesn't want to do anything at the peak of the election campaign or just before or after. So it's going to be an interesting timing, but I think, the Bank of Japan is going to go ahead this summer first.
Okay, brilliant. Politics, the curse of central banks. Okay, thanks a lot for that, Max. So let's move on to Bran then. Bran, let's start with China. These economies headed this year. And just last week, we had another mixed bag of data. So what's your take on what's going on?
Yeah, I think that's right. We are, there is a bit of uncertainty, I think, about both the current state of conditions in China and obviously the outlook. But I would say probably the main factor that is still influencing what's going on is the weakness that we're seeing in the property market. That's extended for well over a year now. And last week, just before we got the key activity data, we did get the house price number, which was actually a bigger year-over-year decline in April relative to March, down 3.1% of the year. So things aren't really getting better at all in the property market, despite some of the measures that authorities have put in place over the last few months to try and improve liquidity conditions and get lending happening in that sector.
So I was going to ask you, can I quickly ask you about that? Because they came out with a huge package, didn't they, back end of last week, almost $43 billion to try and do something to support this real estate market.
Yeah.
Do you think that's going to be enough? And has that actually been taken well? I mean, do people think it's going to be enough, or are they still dubious?
Well, I think people are obviously reluctant to within China to criticise the policy settings and to be too pointed in sort of their analysis of what might be going on. But I think it is a sign that Beijing is definitely worried that what they've done previously isn't enough, and that they need to do more. And definitely, if you look at those last set of house price numbers, you can see why they are concerned. So I think that is the big question, whether that will be enough to turn things around, just given how protracted this downturn in the property market has been.
All right, in terms of the rest of the economy, I mean, just a quick look at the numbers. It seems to me that we've got the goods producing sector, which isn't doing too badly, but it's certainly running well ahead of what we've seen coming out of the consumption side. So, I mean, it does seem to be a case of real excess supply at the moment. Is that right?
Well, again, I mean, if you look at the industrial production numbers, they've been humming along okay. So we are, seeing a decent amount of activity across the economy. But looking at probably, the numbers that you would rather look at, I think, would be the PMI survey numbers, and they're just showing both the manufacturing sector and the non-manufacturing sector sort of bumping around in that sort of 50 to 52, 53 range. So that is, it's definitely better than contraction, which is something that we've seen not that long ago. So there are signs of life in both the manufacturing and non-manufacturing sector, but it's just not really enough, I think, to put a dent in some of the other issues that the Chinese economy is facing.
All right. What about inflation? Because has it actually turned the corner now? I think we've had 3 months worth now of actually positive readings on the CPI. I think the core PI is not doing too badly now either. So, I mean, have we got to the stage now whereby the big risk of deflation is behind us, or is that still something which people are worried about?
Well, I think when we say 3 months, we've got to bear in mind that 2 of those months were January and February, which is the period of the year each year that's impacted by the timing of Lunar New Year holidays. Right. So you did have a big spike in inflation in January, and then that fell down again in February. So you've sort of got to average those 2 numbers out, and that shows sort of a sort of marginally positive rate of growth in prices for the first 2 months of the year, and that was continued into March. So I mean, we're definitely not in the state that we were towards the end of 2024 when that index was falling on the year. But I still think relative to most other parts of the world, the price pressures are still very weak in China, both with consumer prices and particularly producer prices are still falling year over year.
Okay, I think the was it the April Politburo meeting, and one of the lines which came out of that was that effective demand is still insufficient. So I guess the bottom line question is then, I mean, are we still in an environment whereby we could see another cut in loan prime rate or a reduction in banks' reserve requirements, or is that now past?
I think that's still on the cards. I mean, we just had the loan prime rate announcement today, and they left it on hold. So that's being on hold now for 3 months for both the 2 year and the 5 year. Sorry, the 1 year and the 5 year. So they are, I think, being cautious. They've got other factors that they want to bear in mind, such as the exchange rate. So they don't probably want to go too aggressively on adjusting policy settings. But that is still an option that they could do more. That said, when we did have the activity numbers out last week, what they sort of stressed then was that they want to try and front load some of the measures that they're thinking of, but without actually doing more, in terms of easing policy. So that does suggest that they think that the things that they've done over the last few months will actually, be enough to turn things around, get rid of deflation, get stronger growth in the economy, and they're sort of hoping that they don't have to do too much more as a result.
Okay, fair enough. And last one, in terms of, you mentioned the exchange rate in there. If we were to see, very unlikely, I know, but an early cut in Federal Reserve interest rates, do you think that would open the door for the Chinese to cut, or would they just be perhaps grateful for it, but not take too much notice?
I think that would make it easier for them, definitely. But they might prefer to sort of see what benefit that does to the exchange rate and to the export demand, and sort of without having to follow suit. So, they haven't generally been too responsive to changes in what the Fed's doing in recent years. But that's obviously just another setting that they would take into account when they're deciding what they're going to do.
Okay, fair enough. Right, let's get across to your part of the world in Australia.
Yep.
In April, the IMF said that Australia was feeling the pinch of rising interest rates more than any other advanced economy. But it does seem as if talk of imminent interest rate cuts is fading. So what's happening in your part of the world?
Yeah, I mean, it's been a pretty consistent message from the Reserve Bank of Australia in recent months. The line that they're using is we're not ruling anything in and we're not ruling anything out.
Right.
So they're really trying to keep their options open and not be committed to any move. Obviously, they hiked rates back in November, and that was a bit of a shock to the system for a lot of people, and they definitely copped a bit of criticism for that. And since then, they've just been holding the line. So we had the most recent rate decision earlier this month where they left rates on hold, and Governor Michelle Bullock faced a lot of questions about it, and she was just very, very non-committal about any rate reductions, and if anything, she was sort of trying to keep her options open. That if inflation expectations in particular were to pick up again, they would leave they would not rule out the possibility that they'd have to hike again.
All right. I think remember right with the budget last week, didn't we? Did that have any implications for how the economy is going to fare or what the RBA might do?
Well, she was asked that prior to the budget, and she was obviously trying to not be too political and not get into trouble with what she was saying. But the clear message that she was saying was that she was hoping the budget would help her out with sort of some helping to get the cost of living down and to reduce the upward pressure on inflation that they're saying. Now, one of the big measures of that budget was some energy price rebates for every household in Australia, basically. And so hopefully that will have a bit of an impact on headline CPI going forward. But there probably wasn't enough in that to be really confident that we're going to see some of the other upward pressures on inflation abate anytime soon. So the RBA is still confident that inflation is trending lower, and I think that they would still have that view despite what we saw in the budget last week. but they're still, as they've been pretty consistent for a while now, they're still very mindful of the upside risks to that inflation outlook.
All right, fair enough. New Zealand, then we get the RBNZ meeting tomorrow, isn't there? What's going on there?
Well, again, I don't think there's any expectation that they're going to cut soon. So they were very, the last time they met, they were very adamant that restrictive policy is still the way to go, that they still need a further decline in capacity pressures, that they still need to see this level of policy remain at a restrictive period, at a restrictive level, for a sustained period in order to sort of bring inflation down. So it's really hard to see any change to that message this week. The inflation numbers, are still above where they'd like them to be, even though they do think that it's trending in the right direction. But I think until they see further evidence of that, there's not going to be any appetite to start pulling back on that tight policy.
Okay, I think it's fair to say, is it not, that you've got the likes of business and consumer sentiment are declining now? I think wage growth is down too. So, I mean, is there a chance we might see rates being cut later on in the year?
I think that, similar to the RBA, they're not really mindful of doing that anytime soon. They're always going to be mainly focused on getting that inflation number back to target. Until they're confident that's going to happen, I don't think they're going to pay as much attention to some of those other indicators that you mentioned. They're definitely talking about the impact that it's having on demand, and have also been talking about the housing market as well, and just cost of living pressure. So they're mindful of these other factors, but until I think they see real clear evidence that they're going to get inflation back to target, there's not going to be an appetite to reduce policy anytime soon.
Okay, fair enough. What about India? I mean, it's a part of the world you've certainly been talking up in recent podcasts. You still bullish on that?
Yeah, they're still, I think, going reasonably well. I mean, definitely, if you look at the PMI surveys, they're motoring along very well in both the manufacturing and services sector. PMI readings in the high 50s. That's also being reflected in the GDP numbers and the industrial production numbers. So most of the key activity numbers are humming along pretty well. Obviously, they do have a greater reliance on the agriculture sector on their headline GDP. So that's always vulnerable to sort of weather events. But generally speaking, the activity numbers are very strong. And so I think that keeps the focus very much on inflation, which has generally tracked lower, but is still sort of hostage to developments in food prices in particular. So they've had a fair bit of policy stability for a while now, and I think that's going to continue on again until they sort of see that inflation trend lower. But the key point is that they do have a little bit more flexibility to sort of work on inflation, because the activity numbers have been pretty strong.
Okay, fair enough. Anything else from your part of the world?
No, I think it's a pretty consistent message that outside of China, the central banks in the region are still very much focused on the inflation targets that they've set for themselves, and getting that headline inflation number lower. They're, I think, pretty confident again that the current level of settings will have that impact over the next 12 or 18 months. But they want to really see that happen before they sort of declare victory and start unwinding some of that policy restriction.
Okay, brilliant. Many thanks for that, Brian, then. Right, well, let's move across to my bit of the world and Europe, where investors still very much seem convinced that the ECB will be cutting interest rates by, 25 basis points at their next meeting on the 6th of June. Pretty well, all of the central bank's rhetoric in recent weeks has been dovish, or certainly almost telling the market, it seems, that there will be a cut coming up next month. To the extent now, I think that financial markets and investors in general would be hugely disappointed, and certainly none too happy, should the central bank not deliver Of course, a bit like Brian's talking about, it's all inflation and inflation, what's driving central bank policy in Europe at the moment. And on that front, basically the news has been pretty good. The April number came in at 2.4% on the headline. More importantly, the core rate was down again. Now it's just 2.7%, down from 2.9%. We'll get an update on inflation before the ECB's meeting. That's due on May the 31st, but it would have to be really bad, I think, to stop the ECB coming out and lowering rates in June time. The first quarter economy moved out of what turned out to be a very mild recession in the second half of last year, but growth was only, a 0.3% at a quarterly rate, so it remains sluggish, and most of the leading indicators are hardly bullish, with manufacturing in particular still struggling. So certainly there's nothing in terms of what's going on within the real economy to prevent the idea that, well, we'll see the ECB easing again. One word of caution, I suppose, is what's going on in terms of services, where inflation, it fell for the first time since last October in the April data, but at 3.7%, it's still almost double the 2% target. And of course, in addition to which, the labour market does still remain very tight. In March, the unemployment rate was at 6.5%. That was unchanged, but it equals its record low. And the ECB are clearly concerned that there's still the risk that we could see wages responding to that. On that front, keep an eye on for this Thursday, we'll get the ECB releasing their so-called negotiated wage data. If we were to see a surprise increase there, it could just unsettle the markets before the ECB meeting, because the ECB has made a lot of noise to the effect that they want to see further evidence that not just that inflation's coming down towards target, but wages are also decelerating in order to ensure that when they do get to the target, it's going to be met on a sustainable basis. Bottom line then is, I think that almost certainly we will see key interest rates being cut in June, but beyond that, at this stage anyway, the profile is still far from certain. In the UK, well, the economy proved surprisingly strong in the first quarter. It actually grew at a 0.6% quarterly rate. That's more than reversed the mild recession we saw at the back end of 2023. With both services and manufacturing making gains, it was at least a reasonably broad-based improvement in total output. Consumption was, I suppose, a little bit on the soft side, but importantly, business investment was strong. All that said, the Bank of England has clearly become more dovish in recent weeks, and that was reflected in the May MPC vote, where we saw a couple of dissenters calling for an immediate 25 basis point cut. Previously, it just been one in favour of reducing rates now. So it looks as if there is a gradual shift in that direction. Inflation, as ever, still very much the key. The March inflation rate was at 3.2%, the core at 4.2%, so still too high. And of course, services, which is a key area that the bank's focusing upon, that was still up at 6%, so 3 times the target rate. Now, we're going to see base effects have an important negative impact on headline inflation over the next couple of months or so. April data are due on Wednesday, and that's expected to see the headline rate fall from 3.2% to just 2.2%. Before the quarter's out, we'll probably see it below 2%. However, say this is due to base effects, and the bank itself is expecting inflation to start moving back up again, closer to the 3% mark over the second half of this year, although it does maintain that the medium-term outlook remains very uncertain. Not helping what the bank does, or at least in its decision-making, it really still doesn't trust the official labour force data, but it does believe that the labour market is, while it's tight, it is at least easing. That said, wage growth remains high, and we got regular earnings growth at the moment in at 6.0% in the first quarter, and it's kind of looking sticky around that level. So I think when we get to the next Bank of England meeting on the 20th of June, the cut is certainly possible, because it does seem as if a number of MPC members are beginning to move in that direction. But on the whole, unless we get some a particularly weak labour market report next time round, and in particular a fall in earnings growth, the majority of MPC members will want to see additional data showing core inflation is going to stay down before actually pulling the trigger. Of note, in terms of quantitative tightening policy, Andrew Bailey said again last week that quantitative tightening can continue during the rate cutting cycle. So expect the bank to continue to look to shrink its balance sheet over coming months and quarters. To Switzerland then, well, Switzerland, what was the first of a G10 group of central banks to cut interest rate back in March when they reduced their policy rate by 25 basis points to 1.5%. And that really followed a string of sub 2% headline and core inflation prints since the middle of last year. The economy appears to be growing modestly. Inflation is still well below target. We say below target, below 2% within the Swiss National Bank's price stability range of 0 to 2. It's 1.4% on the headline basis in April. The core rate was only 1.2%. And it really has been pretty stable around that kind of sort of level for some while now. So there's certainly a possibility that we could see the SNB come out and cut again once we get into their June meeting. That said, it's worth keeping an eye on the Swiss franc. That's lost around, 6% or so of its value against the euro so far in 2024. And of course, as we know, the Swiss National Bank has become in favour of a strong franc and certainly more recently a stable franc as a means of maintaining its progress on disinflation. So it could be that it's going to be a little bit concerned that with the Fed seemingly now on hold, if we were to see them come out and certainly make a unilateral rate cut, which seems unlikely with the ECB about to move, it could unsettle the franc further. So I think it's certainly see how the data come in, see how the franc performs, possible cut by the Swiss National Bank towards the end of June. That's also June 20, the same day as the Bank of England. But beyond that, it's probably about it. I think for the time being, I really will want to see the Swiss franc stabilise. Okay, then I think that's the bulk I should be mentioning in terms of Europe. One last thing, though, before we go, we have European elections running between the 6th and 9th of June. They're not expected to have a major impact on financial markets. Nonetheless, national elections have been showing something of a swing to the right over the course of the last year or so in a number of countries, and it may make for perhaps a slightly more, let's say, mixed or messy composition for the European Parliament, which in worst case could make getting through new policy measures and structural adjustments like that much more problematic. Were that to be the case, it could be a slight negative as far as the euro is concerned, but by and large, I think the financial markets don't seem to be too interested in European politics at the moment and really much more focused upon what's going on with inflation. Okay, then, well, let's leave it there for this edition. Looking around the world, there's clearly enough surprises in the data to keep private investors and central banks on their toes. So do make sure you keep up to date with all what's going on, what's expected, what's happened, and what it all means for in Econoday's global economic calendar. On behalf of Terry, Brian, me, and Max, thanks as always for listening. And we'll all be back with another podcast very soon. Bye for now.